Well, welcome everybody, and thank you for joining us today. Today, we're sharing lessons that we've learned after working for decades in the securities industry with both retirees and pre-retirees through a variety of different market environments, life transitions, and and financial planning situations. So I think we're going to draw on a lot of experience that Ryan and I have had over the years, and our hope is to benefit you as you either enter retirement or go through retirement. We're going to keep today's presentation fast-paced and energetic, so grab a notepad and jot down any topics that are pertinent to your situation for further research. Ryan, just to introduce myself real quickly, my name is Chris Gilmor. I'm a senior wealth manager with Stansberry Asset Management. I'm also a CFP, a certified financial planner. I've been in the industry for a bunch of years, 25 plus, and I feel like I've been through a lot of different market scenarios, so I'm hoping that I can add some insights here. I'm located just over the Golden Gate Bridge in Northern California. Ryan, perhaps you want to introduce yourself.
Yes, thank you as well, Chris. And thank you to everyone who is in attendance today. We're excited to have you and look forward to kicking off today's presentation, unveiling some of the secrets as it relates to a happy retirement. Thanks for the brief introduction. But again, my name is Ryan Walker. I'm a senior wealth manager here at Stansberry Asset Management. Been in the industry for upwards of 15 years or so, and am based in Camas, Washington, in the Pacific Northwest, just outside Portland, Oregon. I'm also a certified financial planner and a certified exit planning advisor, allowing me to help business owners transition from entrepreneurship to retirement and managing the complex weave related to the unwinding of business ownership and incorporating that into a retirement plan. Just to recap what Chris has mentioned at the top of the webinar, we truly believe that retirement planning goes well beyond investments, although today's presentation, we will be touching on the investment component, particularly the emotional and behavioral components surrounding investment management and staying disciplined. We also believe that there are many common themes that result in a more successful retirement. We'll be touching on many of those themes today. And just before we start to kick off the agenda, as a broader reminder, all of our recorded webinars, including today's, are posted on our website at stansberryam.com. Just click on the Insights tab and then select On Demand Webinars. You'll be able to access the full cache of historical webinars that we've recorded in the past, typically on a monthly basis. So there's a lot of really great, helpful, knowledgeable, and informative webinars there at your complete disposal. So let's transition here to today's webinar. We're going to be focusing on 5 primary pillars, important areas that we believe contribute to overall retirement success and, moreover, happy retirement. We'll start with the importance of creating a flexible financial plan that can adapt to changes in life circumstances. Also discuss stock market volatility and how that balances out with investment risk. Cover one of the most important planning features as well related to healthcare, how to incorporate that into a long-term financial plan, and some tips and tricks that we have up our sleeves to share with the audience today. And then we'll wrap up with the importance of estate organization and evaluation, some of the key estate planning documents that are important to have in place too. But the bottom line is that we're going to be covering, from a high level perspective, flexible financial planning, stock market volatility management, balancing out growth versus risk management, healthcare and Medicare related planning, and estate planning topics, along with organization. So I'll turn things back over to Chris for a brief introduction of our firm's background here.
Wonderful, Ryan. Thank you very much. Before we dive in, I just want to walk through who SAM is. We are a registered investment advisor, an RIA. That makes us a fiduciary to every one of our clients that we work with. We focus on holistic financial planning and investment management. Now, while investments are important, we believe retirement planning requires coordination across taxes, across healthcare, across estate planning, income management, all the items that Ryan just addressed in his earlier piece. Bullet points were founded in 2016, so we're now celebrating our 10-year anniversary, and we currently manage about $1.3 billion in assets. Now, that 1.3 is largely in the stock and bond universe for the most part, but we do also have, as recently as 2023, we developed an alternative sleeve that's allocated to currently private credit. So we'll be touching on that as well during this presentation. We have office locations across the United States, including Texas. We actually have 2 in New York, California, where I am, Washington, where Ryan is. And we cater to families, to individuals, yes, institutions, and yes, businesses. One of the biggest mistakes, Ryan, I found along the way that I see clients doing is seeing financial planning as a one-time event. It's not. It's an evolution. Because your circumstances change during retirement and change over the course of your life, you need to evolve with it. So retirement, remember, it's not a day when you leave the office. It's a period of time subsequent to leaving the office. So it can last 25, 30 years or longer. So your plan needs to evolve with you and your situation. Retirements generally can be dynamic. Those life changes that come in and throw you on your heels, you need to adjust for those. So flexibility becomes crucial. So best financial plans don't eliminate uncertainty. To be clear, they help prepare for it. Many retirement decisions involve trade-off between spending, taxes and the implications of which may be an implication of that spending, investments, and then whatever your future goals are. One of the things I wanted to talk about a little bit today was Roth conversions, which I know is a hot button item for a number of people. And just to take a step back really quickly, a Roth account is a tax-free IRA, right? Versus a traditional IRA, which is tax-deferred, or a 401k, which likewise is tax-deferred. A Roth account will, once the money is in there, grow tax-free for you forever, right? Until you start drawing. Well, even after you start drawing on it, you're not going to be taxed on it. Versus the deferred account, which will be taxed as regular income when you begin to draw on it. Now, it's important to remember that there is something called an RMD, which is a required minimum distribution. So at age 73, you're going to need to start, the government mandates that you start pulling money from that IRA. With the Roth, you do not have that RMD. Now, a Roth conversion is essentially your ability to move money from that tax-deferred vehicle, whatever it is, be it a traditional, be it a 401k or a simple IRA, to the Roth. And you can do it over a period of time, but you want to focus on doing it in years where it's more tax advantaged. Because when you pull money from that IRA, from that traditional IRA, you are going to be paying income taxes on it. So you want to do it in a measured way, and you want to observe the cadence and time frame when you do it. So for instance, you might want to generally focus on low income years. So it's important to do is to work with your wealth manager, to work with your CPA, to identify the time frame and the cadence of those conversion dollars. Ryan, do you have any thoughts or comments on the Roth conversion?
I work with, multiple retirees throughout the year on determining whether or not Roth conversions may be an appropriate solution for their circumstances. And while there's not a one-size-fits-all rule for everybody, the good rule of thumb is to think about whether or not a Roth conversion would be appropriate after retirement, but before required minimum distributions kick in. Current RMD rules apply when you reach age 73. So in a hypothetical situation, if I'm working with a retiree at age 65, there may be a 7 or 8 year window where we could target specific dollar amounts to be converted from pre-tax or tax deferred IRAs, like a traditional IRA, into a Roth IRA, basically locking in for those several years, and also having the side effect of reducing your required minimum distribution when that kicks in at age 73. Again, an individualized analysis is recommended before taking any action there, but it's a good rule of thumb. If you're in that age range, certainly bring that up with your wealth manager, and we can do some assessments here to determine if you might be a good candidate for that. To transition on here, you'll see a couple important lifestyle goals or major life changes that could impact your overall financial circumstances as well. And the reason why we're highlighting these is because these goals are not regularly reoccurring expenses. It's not a mortgage, it's not an electricity bill or filling up your gas tank. It's a very unpredictable expense, and it comes up irregularly. So family milestones, for instance, hopefully, weddings are going to be a one-time financial gift or a support mechanism if that's of importance to a particular client, or an anniversary gift or travel plans, perhaps remodeling the home or relocating to a different home, either upsizing or downsizing or moving to a different state. These are all important goals that have one-time impacts on a client's financial circumstances. And I found that some of the most happiest retirees are transparent with me about what their plans might be so that we can build that into the overall plan.
Yeah, exactly. Thank you, Ryan. And you do an excellent job of addressing kind of those one-off items, but income and withdrawal sequencing is also crucial, obviously, in retirement. In part, we were talking about the Roth, which is a tax-free vehicle. So I found, and what I do with many of my clients is I emphasize the importance of having different buckets for each source of income in your retirement years. So one bucket would be allocated to tax-free assets, which you can generally have sit there for a period of time. So a Roth is the last bucket I want to touch. The next bucket might be tax-deferred money, like your traditional IRA. At age 73, you're going to need to draw from that. Whatever remains in that account, there's a calculation that determines how much income you're going to be required by the government to take out. So that's the second bucket. And the third bucket would be your taxable bucket, which is just your taxable money, the money that sits there and is sort of you have immediate access to and you can use to pay your household expenses. And what's important about the sequencing is you can use, because each one of those mechanisms, each one of those buckets have a different tax burden attached to it. So you can use, by being smart about which bucket you pull from, you can manage your taxes over your entire retirement.
That brings us to our last bullet point on this slide related to stress testing, which is a form of retirement readiness and an analysis that we certainly use as a means to gauge, events that may be out of our control that can impact the viability of a long-term plan. The best way to illustrate that is through a visual here, which we put together on the next slide. And this really highlights periods where, as I mentioned, things occurring outside of the norm, outside of your own control as well. You'll notice on the far left of this chart is a baseline likelihood of success. And again, these numbers are just hypothetical simulations, just showing the impact of various outcomes on the longevity of a financial plan in the long run. Some examples shown here are market downturns, higher inflation expectations versus the assumptions that are used, unexpected healthcare costs or increased longevity, lower than expected portfolio returns, or even increased spending needs over time. These stress test examples give us an idea of the impact that they may have on, again, the longevity, the likelihood of success of a retirement plan. So every time we work with clients to develop a holistic financial and retirement plan, it makes sense to go through these various risk factors with your wealth manager to understand what the long-term impact might be. Anything that you'd like to point out here on this screen?
Yeah, I just would just highlight to your point that while a baseline plan, in this particular example, reflects 100% certainty that a client will succeed in retirement, there are unforeseen elements that can impact that likelihood. I mean, in this particular plan, it looks like inflation had an unusually high impact, pulling that 100% likelihood plan from that level all the way down to figure around 81, 82% likelihood. So while that's still within our comfort range, obviously as it drifts downward, that's something we don't like, and we can actively address and change some of our assumptions when we identify that there is weakness in the plan.
Yeah, excellent point there, Chris. And I would just say that, of course, the bottom line comes that or results from confidence and confidence in your plan. That doesn't come from just hoping nothing goes wrong. It comes from knowing that you're going to be likely okay if something does. These are more extreme scenarios, of course, but that stress testing analysis can add an additional an additional level of peace of mind to the overall financial plan. Now let's talk about one of the biggest challenges that retirees can face emotionally, and that would be stock market volatility. So volatility is a very normal and actually healthy component of investing. In fact, uncertainty is often the price that investors pay for the long-term returns that are so well associated with investing in the stock market. The primary challenge, though, is that the disciplined approach when it comes to interpreting very scary headlines and how those headlines can impact us emotionally and perhaps encourage us to respond in a way that can do more harm than good. Emotional decisions can be very costly. Of course, the bottom line name of the game is buy low, sell high. However, when you're being exposed to scary news headlines, stock market volatility, that can impact your emotions to drive you to want to make changes that are outside of your control relative to the investment approach. So the most important aspect of investment success, in our opinion, would be to maintaining a long-term perspective and trying your best to manage behavior and emotions rather than be influenced by them into wanting to make some significant changes to your investment portfolio. So one of the ways to do that is to very much focus on your individualized goals rather than the headlines and volatility. And that discipline really beats trying to predict what the market is going to do and respond in that respect. Any additional points you'd like to add here, Chris?
No, I think you nailed it, Ryan. It's so important to you hear it. It's a bit of a catchphrase, but that discipline that you reference, oftentimes clients can whipsaw themselves, can put themselves in a position where they let fear drive the investment decision and near-term market machinations drive the investment decision versus good, fundamental, thoughtful investment analysis. And that, unfortunately, I've seen that do more harm than good over the years, which I'm going to address in the next slide. So in the short term, and this slide reflects earnings per share expected growth, over the years. And you see a reflection of the average earnings growth over the longer term in the dotted line, where the solid line is what the actual numbers were. And you can see these are analyst predictions for earnings growth in 26 and then beyond. So the short-term market basically reacts to news and to sentiment. Over the longer term, it's these corporate earnings that drive the strongest movement in stock prices, and that's what you want. Yes, getting caught up in the near term can be damaging, and you want to avoid that, but it's hard to sometimes do, right? So you just got to be focused on that. In the short term, there's going to be uncertainty. In the long term, it's earnings growth, and it's the business fundamentals that matter, and it's patience that's awarded. That's what we're talking about relative to discipline. The market will eventually follow profitabilities. There's periods of time where, the earnings might be robust for a company, but the earnings the company performance is not what you'd hoped it would be. But ultimately, there will be a reversion. And when that reversion happens, you want to be a holder of that security. Ryan, I'd love to hear your thoughts.
Yeah, totally agree. One thing just to add here, and not to say that this is a perfect indicator on what's to come in 2027 or 2028, but you can see, as represented in the gold squares on this chart, that earnings per share are expected to increase quite dramatically in the years to come. Now, these are forecasts. Of course, things can happen, black swan events outside of our control that can impact the profitability of companies. But at least there is a widespread sense of bullishness in the marketplace, and that could have a positive implication on the trajectory of the market in the years to come. But very important point to
yeah, thank you, Ryan. Exactly right.
Yeah.
This chart helps to reinforce the relationship between economic activity, corporate profitability, and market returns. Short-term movements are unpredictable, as we've talked about, but underlying business growth remains important. And here, what you see is a breakdown of expectations from some of the top investment houses on Wall Street. You can see that currently we're at about right around 7,400. The expected average for the year is upwards of 7,800, but you see a bit of a consensus around 8,000 or the 8,100 area, where these firms are really pretty bullish about the outcome of for the 2026 year. So we'll see how this plays out. Notoriously, these can be a little bit inaccurate, so we want to take it with a grain of salt. But currently, the sentiment is a favorable one for the year.
Yes, absolutely, Chris. And one extra data point just to highlight here is the difference between a recent last price of the S&P 500 and the average predicted year-end targets represents between around a 5 to 7% increase where we are at this point in the year. So over the next 6 months or so, roughly a 5 to 7% increase in the S&P 500, which is a relatively modest expectation. So we're not seeing extreme bullish expectations, nor are we experiencing extreme bearish expectations. Bank of America tends to be on the lower end of the spectrum in most years, and is the leading investment banking firm that is suggesting a potential drop in S&P price levels by the end of the year. But this is really important point to hit home.
Thank you, Ryan. Now, retirement investing isn't about maximizing returns, despite what we've been talking about here in the last several slides. It's about maximizing the probability of achieving your personal goals. Whatever your personal goals are, that is what we are trying to target here. Many retirees become, frankly, overly conservative out of fear. However, retirement, again, lasts decades, which means that growth remains an important component of a successful retirement. That said, please don't let me take risk off the table. Risk needs to be managed thoughtfully. You can have thoughtful growth within your portfolio, and in doing so, in some cases, can dramatically increase the likelihood of a successful retirement. And that's honestly the point of this call, and the point of what we're trying to achieve for you as individual investors. Inflation remains a risk. We talked about that in an early slide. Growth investments still matter in that case, right? If inflation is eating away at the value of your dollar, then you need to have a vehicle that's working for you to mitigate that danger and that risk. Ryan, you probably have some comments on this.
Yeah, thank you. I would say that fixed income does oftentimes play a role to increase the level of stability, especially during periods of volatility, and a well-balanced and diversified strategy. But the greatest risk for retirees, especially, we're all living longer. There's been so many advancements in healthcare, and a lot of folks are trying to maintain their health through being physically fit and active, and maintaining an emotional balance that allows them to stay very involved in their community and such. So that longevity risk can play a part if you get too conservative too early in life. For an average retiree, we should think of time horizon of probably at least 30 or 40 plus years, depending on current health situation, and then also your family heritage and genes play a factor when it comes to longevity as well. But the bottom line is that long-term growth through equities for a portion of your portfolio, if not the majority, may make sense depending on your risk tolerance and your specific goals.
Yeah.
Also, alternative investments can also manage a level of risk through further diversification that are less correlated to the volatility that we might see in the stock market, or even to the extent that we may see in the fixed income or bond market.
Yeah, thank you, Ryan. Excellent point. And again, we are always looking for tools that we can utilize for our client base to manage the risk, so that if we can pare down volatility or within a portfolio while increasing the potential for return, that's kind of a silver bullet for us, and we love that. And alternatives, in a general sense, can play a role in that. There are alternatives that are more risk on. We generally don't go play in that sandbox. We focus on alternatives that generate stable returns, but over the and are non-market correlated, as Ryan just spoke to. What you see in front of you is what's referred to commonly as the efficient frontier, and of the two bars, the lower bar with the blue, orange, and gray dots are representative of varied stock and bond allocation. So if you look at the orange button right in the center of your screen, you can see that has a volatility of about 9.7 and an expected return of about 8.4%. And that's a 60% equity allocation and a 40% fixed income allocation. So we thought to ourselves, hey, what can we do to manage the risk down, but potentially shift, which is what you see here in the second line, shift the efficient frontier upward, which is what we believe alternatives do. Because of their non-market correlation, you're not subject to the wild machinations of the market on any given day. There are shortcomings, of course, which we can address, and you can address with your wealth manager for alternatives in terms of liquidity or in terms of the visibility or transparency. But they do offer an excellent tool to get enhanced returns without taking excess risk, as is illustrated by the green button just above the orange button. So you see that's a reflection of a 50% allocation to equities, a 20% allocation to fixed income, and then the 30% allocation to alternatives. Now, volatility is roughly the same, just shy of the 60-40 allocation to equities and fixed income that I just illustrated in the orange button. But so it's 9.5% volatility, but the annualized return has increased from 8.4 all the way up to 9.4%. So you can see how, hey, if I can get more return by being a little bit more thoughtfully diversified, it can be advantageous for me in the longer term. Ryan, I'm sure you have some comments.
Yeah, thank you. I would just highlight that alternative investments are not a one-size-fits-all solution for everybody. There are some negatives associated with alternative investments, including minimum lockup periods, lack of liquidity. There are some other inherent risks that are associated with alternative investments that may not be present in equities or fixed income. However, they do tend to be not as correlated to the volatility that's associated with traditional asset classes. Also, alternatives may only be available to you if you're an accredited investor or a qualified purchaser. So it would make sense to have a thorough conversation about what your goals, your risk tolerance, and your investment preferences are with your wealth manager before considering incorporating alternatives into your investment strategy. So switching gears a little bit, this slide is called Signs of Speculative Enthusiasm. And the theme that we've been witnessing much of that enthusiasm is through the IPO market. Most recently, we've all heard that the SpaceX company has hit the secondary market after launching their IPO. And the illustration that you can see on the slide here is just representative of a typical market cycle associated with an IPO, where retail investors tend to buy in at the peak, as you can see in the chart represented with the number 2. Other themes of investing tend to be associated with that retail buying, such as FOMO, which stands for fear of missing out. It definitely impacts decisions when it comes to when and how to buy into a particularly trendy investment class. Narratives can definitely drive valuations. And one of the goals of the investment bankers that are packaging IPOs are to get the most high valuations as possible when that company does begin trading on the secondary market. However, the downturn or the down big negative about investing in IPOs is that investor sentiment can change dramatically and quite quickly. Here at SAM, we try to avoid chasing short-term trends by staying disciplined and well-diversified, focusing on companies with quality fundamentals rather than just the flavor of the day. You can see also represented in this typical IPO life cycle is that retail investors tend to get hurt the most as compared to institutional investors or investors who are founders or employees of the company, because they tend to sell out of an IPO towards the bottom under phase 3. And then a typical IPO tends to go sideways for a few years. If it winds up being a viable IPO, then that's when you typically see a long-term breakout. There are a couple other big IPOs slated to hit the market later this year, north of $1 trillion each in valuation. OpenAI is one of them. Anthropic is another popular IPO that is gaining some traction here, likely to launch between now and the end of the year. Again, our primary preference is on investing in companies with quality fundamentals and not chasing the heat associated with the IPO market. Anything that you'd like to add here, Chris?
Yeah, I couldn't You did a great job there, but I want to emphasize the speculative word in the title of this cell here. It is speculation versus what we've been talking about prior to this in terms of growth and in terms of risk management. This is no reflection on Elon Musk or the viability of SpaceX. It's just historically the behavior that IPOs generally exhibit. I will say that SpaceX went public at 135. The first trade was 150 a share, and it's traded up to 225, almost 226 actually. So it traded way up. I mean, just exploded out of the blocks, and then now it's right down pretty darn close to the 150 level as of today. So it just speaks to the wild volatility and the potential danger. It doesn't have earnings right now. Its revenues are robust, but it's a risky play. So we just want to be cognizant of that as we position solutions to clients.
Absolutely, and very pertinent to the times we're in today. So on to our next section here, healthcare and Medicare planning. Clearly, healthcare expenses and planning for those expenses is one of the most important financial planning items, but it's often overlooked when it comes to how to manage those expenses. It can have a significant impact on retirement cash flow down the road. When it comes to making Medicare-related decisions, they're not just healthcare decisions, they're also financial planning decisions. Related to taxes in particular, income levels can influence your Medicare premiums through what's called IRMAA, IRMAA. You can see a table of IRMAA premiums on the screen here for 2026 income. So making proactive planning decisions can be especially valuable, especially if you can manage your taxable income levels. So when it comes to the IRMAA surcharges, as you can see on the chart, based on the projected income or taxable income, whether you're married or a single filer, there are tax planning opportunities to stay within specific tax brackets if you have that ability in order to minimize the impact of IRMAA Medicare surcharges. Now, there is an appeal process using SSA 44. That's the name of a form provided by the Social Security Administration, because there are some qualifying events that can exempt you from having to pay these extra IRMAA surcharges. Some examples of these events would be marriage or divorce, the death of a spouse, work stoppage, in other words, retirement, or reducing your hours of work, loss of income producing property, such as a rental real estate property, loss of pension income, also an employer settlement that may be a one-time income expense or income addition to your taxable income, or other relevant events that can cause a significant income drop. Those changes in income can be reported via Form SSA 44 to potentially exempt you from needing to pay these extra IRMAA surcharges. The appeal process is pretty straightforward. It's just a 1 or 2 page form that gets mailed off to the Social Security Administration for review. The last client that I worked with who sent in that form, they got a response about 3 or 4 weeks later, approving the request to exempt them from those Medicare surcharges. So if you have questions on this, of course, you can reach out to the Social Security Administration to evaluate further. And they have a great website too to learn a little bit more about how to submit that SSA 44. When it comes to healthcare spending assumptions, one of the things that we want to incorporate into a holistic financial plan is the impact of inflation over time. Inflation tends to have a higher impact on healthcare expenses as opposed to regular and ordinary basic living expenses. So we want to take that higher inflation potential into account when developing a holistic financial plan. And then finally, long-term care expenses. Certainly considering them in the last several years of a long-term retirement plan would be a reasonable assumption to make. Women tend to outlive men when in an assisted living or long-term care facility type arrangement. So that's one factor to take into consideration, but usually including a 3 to 5 year long-term care expense towards the end of your plan would be viable to understand how your portfolio may respond to that added expense. So I'll move things back to Chris here to see if you have some comments here on this slide.
Yeah, just on your last point there, Ryan, it sort of reminds me of when we put our family trust together. The lawyer was talking to my wife and I, and in every scenario, every future scenario, I was dying and my wife was going crazy. So, again, it's important to keep those things in mind, in terms of life expectancy. But many retirees also, to build on what we were talking about earlier, relative to the Roth conversion, are surprised to learn that, I have converted all this IRA money, let's say a traditional IRA, and now it's bumped me into this premium that I now need to pay IRMA on. So you just got to be cognizant of it. You need to work with your wealth manager or your CPA to decide, where the thresholds are and position yourself accordingly. So estate planning isn't just about transferring wealth. It's about creating clarity for you and your family. So it's an essential element of this theme, the successful retirement, the happy retirement. So good estate planning helps ensure your wishes are carried out and reduces the stress, not just for you because you have that comfort in knowing that, but that your loved ones might be feeling in an otherwise difficult situation. So keep in mind, you need to stay on top of wills and update them as appropriately. Do the same thing for trusts, please. That's important. Don't just set it and forget it. Review your beneficiary designations. If there's grandchildren that are recent to the situation that you want to include, make sure that the information is updated accordingly. Powers of attorney. As you get older, you might, your facilities begin to wane, and you need to make sure that maybe a younger person, maybe a child, has power of attorney over, to act in your best interests. That, financial directives, healthcare directives, all are in place. You should make sure that that's taken care of. My suggestion would be to have a centralized document organization. You can do this either virtually, or you can do that, in a more analog fashion. And communication, is critical. So make sure you're communicating as appropriate with loved ones. And this is not, again, please, not a set and forget it sort of situation. You want to review this on a regular basis, maybe annually. Maybe it doesn't need to be quite that often, but it should be in a more regular fashion, which actually pivots nicely into the next cell. So one challenge that families face is knowing where important information is located. We've developed this binder, which helps to organize the critical information in one place, including your financial accounts, insurance information, property records. Thank you, Ryan. Ryan is actually showing you a copy of the brochure now. So we're going to be actually sending these out proactively to clients going forward. So if you haven't yet received one or requested one, expect that you're going to be getting something in the mail. But it includes, as I said, property records, insurance information, financial information, key contacts, and also, which you probably don't have, I know I don't have, access instructions for passwords, passwords and user IDs, that sort of thing. So it's all centrally located in one spot. With that said, Ryan, do you have anything to add? Am I missing anything?
One quick reminder: with the proliferation of cryptocurrency investments, this binder could also be used as a place to store appropriately any keys or passwords necessary to access these accounts. Oftentimes they are extremely difficult to log into, especially, God forbid, if something were to happen to you or to your spouse and not having access to those keys. It could be very difficult to recover the value of those cryptocurrencies. So storing, web addresses, URLs, usernames, passwords, crypto keys in a safe place where loved ones know where to locate it would be a great practice to include as well.
I love that. That's great. Yeah.
And this brings me to a quick wrap up and summary here as we wind down today's webinar. But as a reminder, after working with decades with retirees, we've noticed some very common characteristics and themes among those who enjoy retirement the most. It's rarely about having the highest net worth. The main points are a clear plan, emotional discipline, the flexibility to adapt to life changes that may have an impact on the way that your investments are being managed as well. For instance, if there's a a health status change that may have a direct or an indirect impact on the time horizon of an investment, and communicating that with your wealth manager to help take into consideration when it comes to building out the asset allocation and strategy allocations across your portfolio. As Chris mentioned, organized finances. That's a top one for us. And then realistic expectations going forward. Being mindful of the reluctance to wanting to chase heat when it comes to a specific investment class. The importance of maintaining a diversified approach that leverages quality over speculation. By quality, I mean high quality fundamentals, great management teams, durable balance sheets, high quality product lines, and companies that have been around through thick and thin over decades, if not centuries. These tend to be investments with the best long-term durability, the less amount of impact of short-term volatility in the market, and also, let's face it, greater peace of mind in knowing a portfolio that you have set up to provide for the rest of your life is managed in an appropriate and diversified, fundamentally based fashion. So just a quick pitch towards a guide that we put together, a worksheet, mind you. It's a worksheet that we compiled that you can actually request here in this webinar. It's built into the design of the webinar. It can help you balance the emotional aspect of retirement with the financial component. The worksheet is called Designing Your Ideal Week in Retirement. You can see the first page on your screen here. And the main components of this worksheet are to help our clients develop a purpose-driven retirement through meaningful activities, staying socially involved, being mindful of health and overall wellness, intentional weekly routines, and aligning time with your value. So if you're someone who would like a little support in terms of designing an ideal week in retirement that hit on some of these primary topics, make sure to download the PDF here and take advantage of this worksheet we put together for you here.
Thanks very much, Ryan. I appreciate that and appreciate your points there. Our planning process emphasizes the importance of each piece of a client's financial life rather than each of these items individually. Retirement planning and investment management, we certainly address that. Estate planning and the importance of that and communicating with your kids and loved ones. Tax planning in the moment and financial planning, how crucial that can be and what strategies exist. Risk management through not overdoing risk or having or being speculative, but being thoughtful about what exposure you have and when, because that exposure will evolve over time. So strategic investment management is also very crucial. You need to be thoughtful because it's going to have to evolve with the market climate. And you need to always be managing that risk element of it and identifying the opportunities for growth. I want to thank you. Actually, Ryan and I would like to thank you for joining us today. If you submitted questions before or during today's events that we didn't already cover, we'll follow up with you individually. Also, please feel free to reach out to your wealth manager with any questions. That's what we're here for. And we'd be happy to discuss any topics that you may be or that may be relevant to your situation. So that's, again, what we're here for.
Very good. Thank you all for participating. If you'd like to discuss your own individual retirement plan, we'd be happy to schedule a complimentary review with you if you are a prospective client. If you're an existing client, feel free, of course, to reach out directly to your wealth manager. The objective is to identify opportunities, manage risks, and also identify planning strategies that may improve your retirement outlook over time. Remember, the complimentary consultation is available to you. Just scan the QR code here on your screen or put in a note in the chat, and one of our representatives will follow up with you shortly. The last thing need to cover here is just general overall industry disclosures here. But thank you again from the bottom of our hearts for participating in today's webinar. And we look forward to having you join in future webinars down the road. Thank you again from Chris and myself. Take care.
Thanks, yes.